There's been a lot of talk about the world's running out of resources. Natural resources, gold and silver. You hear a lot of people on the internet saying that there's no silver being mined, silver and gold production is going to fall. They were running out of resources, we're very low inventories. A lot of that's wrong. We do have some constraints on production, and the constraints are almost entirely human-made. Geologically, physically, we have a lot of reserves and resources, so I want to run through some of those things there. I'll start by talking about gold. This is gold total supply. Now, the red bars are secondary recovery. There's about 20 million ounces a year or more that is recovered from jewelry and other decorative items and electronics these days increasingly and other things. But the black bars are mine production. It's about 84, 86 million ounces of world mine production per year right now. And you can see it's down from a peak around 98 million ounces 6 years ago. And that peak and decline represents the fact that from 2013 to 2019, gold prices were weak. You can go back before that and you can see a number of periods of time when mine production was rising because the price was high enough to attract investors into gold mining companies and to attract gold mining companies into developing and producing mines. When I started in this business in 1978, 1979, mine production was about 32 million ounces a year. Most of the production came, about 72% came from South Africa. 8 mining houses, about 16 different mining mines. And the South African mining industry said, look, we think that demand for gold is going to grow. It's about 35, 40 million ounces a year. We don't think there's enough there. And we can't grow mine production. And they were right. They couldn't. But from 1980 to 1999, you saw mine production go from 32 million ounces to about 68, 78 million ounces. Almost all of that came from companies that were not gold miners in 1980. There were copper mining companies like Placer Development that became Placer Dome gold mining companies. There were a lot of companies like VRIC that didn't exist until 1983. There were literally about 4 or 5 dozen mining companies. The United States had one major mining company in 1980. Canadian mine production was probably about 1 or 2 million ounces. Australian production was less than 1 million ounces. But the higher price after 1980 led to this massive production of gold. And very importantly, very large increases in mine production from companies that were like a lot of the juniors, development companies, pre-development, and exploration companies here today. 1999, the gold price fell in 1997. It went below $320 an ounce, which was considered our break-even price. You saw mine production start to contract from 2000 into about 2007. During that period of time, gold prices actually started to rise again, but you didn't see an immediate increase in mine production because of the long lead time in exploration, planning, financing, and development. But then you started seeing around 2007 an increase in mine production reacting to the fact that the gold price had gone from $250 an ounce in 2001 to $1,000 in 2008. And then it went even higher into 2011. Then it came off. Mine production reacts to the price because of human activity, not because of a lack of reserves. We are now in a place here, you can see in 2011, 12, 13, we were looking at 1.5, 3.5, 5.5 million ounces of new gold mining capacity coming on stream every year as a result of the mining exploration and development work that started in the mid-aughties as the gold price was rising. After the gold price fell in 2013, exploration and development fell back, and we only had 1.5, 2 million ounces. And then since 2019, it's been 500,000 to 1 million ounces, and this year it's even lower. And we expect that to continue for the next couple years before starting to rise again in a cyclical basis. That's total supply of newly mined gold. The second component is inventories. Now, when we look at gold or silver or any other market, we look at supply being total supply, refined production from mines, and refined production from scrap. We look at fabrication demand. We set investment demand off to the side. It's not in the balance sheet because investment demand is radically different from fabrication demand, and you want to keep it separate. Fabrication demand changes the nature of that. I have a phone, it's got gold in it. That's gold that's been used in fabrication demand. I have gold, it's in a coin, that's gold bullion. We keep inventories separate, but obviously inventories can be sold at any given time. Now, a lot of didacts will say, oh, well, those investors will never sell their gold. And as Ronald Reagan said, never is a long time. Or as Abraham Lincoln said, every man has his price. So you have to pay attention to it. You'll hear people talking about how inventories are at record low levels. On the left here is COMEX inventories, which are not only at record high levels, they're at record high levels 3.5 times what was normal prior to, say, 2020. And then on the right is London Vault gold holdings, which again are at record levels that are significantly higher, something on the order of 30 or 40 or 50% higher than they were prior to 2019, 2020. The London gold reports were only made public, well, they were only reported starting in 2016. So we don't have a lot of historic data, concrete data on how much gold was held there. The third component, okay, this is ETF holdings, which these are actual physical holdings of ETFs. And you can see it's about 130 million ounces right now, which is roughly speaking maybe 10% of the gold that investors hold. Investors hold most of their gold away from the ETFs. This is a chart that I inherited when I took over the research operation that is CPM Group in 1980. It goes back to 1800. The big bold line is cumulative mine production. And you can see we estimated there were a few 100 million ounces of gold that had been mined prior to 1800. And you see a stark acceleration as industrialization radically changed gold recovery after 1900. We estimate there's about 6 billion ounces of gold that have been mined over history, and about 90% of it, we estimate, is relatively identifiable. There's 1.9 million ounces, 1.4 million ounces in private investor holdings, coins and bars. There's another 1.1 held by central banks. There is about 2.8 that's held in jewelry and decorative items and religious objects. And then there's other industrial and stuff. And the amount that you really can't account for is about 10%. I always say, people don't lose gold. They'll lose silver. I'll show you this chart on silver in a second. They'll lose silver. But if you lose an ounce of gold, you lose a silver coin, you're going to look for it to some extent. If you lose an ounce of gold, no one goes to bed that night. You're out in the yard with flashlights looking for that ounce of gold. There was a great time when the United States called in gold coins in 1933. And it's interesting because there were about 54 million ounces of gold coins in the that the United States Treasury had minted. In the month prior to issuing the decree saying turn in your gold, about 40 million ounces of that was voluntarily turned in before the decree was issued. Another 4 million ounces in the ensuing month after the April, I think it was April 4th, maybe April 6th. It wasn't April 1st, decree. And at the end of it all, the Treasury said, okay, we've got like 44, 46, 48 million ounces. There's about 12 million ounces that must have been lost. Actually not, because everybody could have 2 gold coins for each mintage year. So you could have you could have 100 ounces of gold coins that you could keep as collectibles, and a lot of those gold coins had actually been exported. There's a lot of gold out there in above ground inventories, and there's a lot of above ground gold in the ground gold that is in reserves. And resources are scarce to get the data. So these are reserves which are economically mineable at today's price, and the reserve base, which is gold that is sub-economic at today's price, but reasonably could be expected to be economically mineable if the price rose modestly. And resources are much larger than that. And the biggest resources haven't even been measured because they're in China and Eastern Russia. But reserves today are about 30% larger than they were in the 1980s. Now remember that chart I showed you in the 1980s when we were at 32 million ounces a year of mine production and we had 1 billion ounces of reserves, and the miners said, we're running out of gold, we can't grow our production. 32 million ounces. In the ensuing 40 years, we have produced hundreds of millions of ounces, and we have more reserves than we had at the beginning, because part of the calculation of reserves is the price of gold. And in 1980, the price of gold had just gotten up over $190 and averaged $612 that year. And the gold price is higher now, so a lot of those resources that you don't count or others don't count and show us actually have become reserves. As the gold price falls, you'll see declines in reserves, and then as the gold price rises, resources get reclassified as reserves and they grow. But the reality is that there are more reserves in gold now than ever before. Silver, same thing. Massive growth in silver mine production. We're producing about 750, 800 million ounces of gold, of silver from mines each year. There's another 230 million ounces that comes from secondary recovery of not only jewelry and silverware, but electronics and a host of industrial products. As with gold, as the price of silver fell after 2013, the amount of new capacity coming on stream has declined. Now that the silver price has risen again from $15 on average in 2019 to $25, $26 in 2020, maybe a little bit lower in 2021, a little bit lower possibly this year, but $25 is not $15, you will start seeing silver production grow again and new capacity coming on stream. All you have to do is walk around here and talk to these guys out there, because they're the ones that will fill the pipeline in the future. This is silver bullion, and that green thing at the top is bullion coins. You'll see it didn't really exist until about 1984, 85, when the Canadian silver maple leaf and then the US silver eagle started being produced. You had this massive amount, which is implied or estimated unreported silver that investors primarily owned. And it was maybe for 4.5 billion ounces in 1980. I'll get back to that in a second. And what we've seen since then, well, let's stop there. 4.5 billion ounces. So people say, oh, there's a lot of silver out there. Why would the silver price ever rise? Well, it went from $5 to $50 in 1979, 1980, when we had 4.5 billion ounces of silver in bullion. The reason that it went is because investors, a lot of investors looked at the world, they were scared. Inflation was 14%, interest rates were 21%, oil prices had quadrupled. They wanted silver. And the guys who had the 4.5 billion ounces said, yeah, it's good to own silver. I'm not selling you mine, go find it elsewhere. And they bid the price up. So just because you have a lot of silver in above ground inventories doesn't mean that the price can't rise. It does indicate that the price can't rise as sharply as some people would have you believe, and it does indicate that the price can't rise and stay high, because at some point someone says, okay, I bought that stuff at 15, it's gone to 25, I heard it's going to 700, but you know what? I've heard that for 40 years and it hasn't happened. So 25, you know, that's a pretty good profit. I'll sell my silver at 25, and if it falls back to 15, I'll buy it again. And we have clients who have done that over and over again. So there is a lot of silver out there. Now, since 1985, you've seen people selling their bars and buying coins. And that accelerated around 2005 when the price of silver started rising from $5.50 to $10 to $20, peaking on an intraday basis in April of 2011 at 50 and averaging about $30 in 2012. So you've seen people shift into coins. They're a better investment, even though you pay a higher premium. And the bottom blue part is ETFs, which did not exist in silver until about 2005, and they have become about 1 billion ounces of silver inventories. Now, I wanted to go through some of the stuff because you hear a lot of garbage about gold and silver inventories. And one of the things you'll hear is that, hey, we're running out of silver. COMEX doesn't have any silver left in its inventories. We can squeeze it. It's very low level. And the reality is that silver inventories are at a record high. People will look at it and they'll say, oh, well, if you look at open interest in the COMEX silver contract, it's 800 million ounces. There's only 350 million ounces of stocks. That's not enough to cover open interest. That's okay, because most of the people who have those contracts have no interest in taking delivery. They want price exposure, not physical silver. So they don't take delivery. Delivery is usually about 1 or 2 or 5, maybe 10% of the open interest. So the right way to look at it is deliveries versus inventories. Here the red line is inventories, and those little blue bars are the deliveries. And you can see on a percentage basis, it's 5 or 10%. So there's no shortage of silver on the COMEX. I had a chart on London and Shanghai. Both have record amounts of silver, or were at record levels within the last year or so, and they've come off a little bit. But there's an enormous amount of silver in London, Shanghai, New York, around the world, private inventories. There is enormous amounts of silver bullion. And the promoters will tell you, oh, well, yeah, but those guys won't sell. I think, well, at a certain price they will. These are reserves. And you can see here in 1981, we didn't have a reserve figure from the USGS, but they estimated there was 8 billion ounces of silver in the ground on a reserve basis. And we were producing about 400 million ounces a year. Fast forward 40 years, they estimate we have 18 billion ounces of reserve base, and yet we've mined something like 20 billion ounces of silver. Because as we mine the silver, and as people use more silver, the price goes up, and when the price goes up, these guys out here find more silver and mine it. So don't worry about the world running out of silver. Worry about how much silver and gold you have in your inventories. And you can go to our website and you can find all this kind of information. We've been producing these gold and silver and platinum yearbooks since the 1970s. I took over the operation in 1980. I'm not quite that old. These are our cumulative silver figures, where you can see about 58 billion ounces of silver mined over history. And unlike gold, about half of it is estimated to be lost. Because if you lose a silver coin, you'll look for it, but you won't look as hard as if you lost a gold coin. You can go to our website and pick up more. These books, 230 pages, but it's mostly charts and tables, so there's not a lot of reading. Enjoy yourself. Thank you.